Silver stackers gather around. I want to take you on a journey today, a journey through the numbers, the assumptions, and the hidden forces at work, and I can tell you right now what I found is completely unbelievable. Not in the sense of sensational clickbait, but in the sense that when you see the full picture, it shocks your expectations. When you strip away opinions, narratives, and emotional reactions, what you're left with are the numbers. Numbers don't care what we want to believe. They don't bend to political agendas or personal convictions. They're simply there quietly describing reality, and yet it's astonishing how often people ignore them, misinterpret them, or selectively use them to support the story they want to tell. That's why I've always believed that transparency with numbers, truly laying them out, however uncomfortable they might be, is one of the most powerful tools we have for understanding what's actually happening and what's likely to happen next. When I sat down to run the math on silver, I didn't start with an expectation of where it should go. I didn't start with a bias of being bullish or bearish. I began with a blank page just asking what are the drivers. What are the numbers behind those drivers, and how do they fit together? Because if you don't do that, you'll get pulled in by stories, and stories are dangerous when they're not backed by math. A story can tell you silver is going to explode because people are losing faith in currencies. Another story can tell you silver is dead money because it hasn't outperformed equities in years. Both stories sound convincing if you only listen to them in isolation, but the truth doesn't care about narratives. It shows up in the math, so I started with supply. The annual silver mining output is measurable. It's reported by mining companies, tracked by industry groups, and adjusted over time. Today, the world produces around 25,000 metric tons of silver annually. That's the baseline. Now, take a step further. How much of that supply is actually free to hit the market? Not all of it. Some is locked into long-term industrial contracts. Some is retained by producers as a hedge. Some is immediately absorbed into government or private vaults. So, while 25,000 tons is the headline number, the effective float is smaller. That's a key distinction most people don't see because they don't dig far enough into the numbers. Next, let's talk demand. Silver is unique because it straddles two worlds. It's both an industrial metal and a monetary metal. On the industrial side, it's indispensable. You need it in electronics, solar panels, medical applications. Demand in these areas isn't optional. It's structural and it's growing. The global push toward renewable energy alone has silver demand climbing steadily. The solar industry is consuming more silver each year, not less. Even with efforts to thrift or substitute, the efficiency of silver is unmatched in certain applications. That's not opinion, that's chemistry and physics. So when you project forward, you see a consistent upward slope in industrial demand. Now, lay the investment demand on top of that. This is the volatile side. It swings with sentiment, with macro uncertainty, with how people feel about currencies and inflation. But historically, when inflation expectations rise or when confidence in paper assets wanes, investment demand for silver surges. The data is there. In the 1970s, during inflationary periods, silver spiked as investment demand overwhelmed available supply. In the aftermath of 2008, when central banks flooded the system with liquidity, silver demand from investors soared again. The numbers are crystal clear. When people lose faith in fiat money or when real yields turn negative, they flock to hard assets, and silver is a prime beneficiary. Now, here's where radical transparency matters most. When you line up supply and demand, you see the imbalance. The annual supply of silver has been relatively flat for years. Mining is not exploding upward. In fact, new discoveries are rarer, grades are declining, and bringing new mines online takes a decade or more. At the same time, industrial demand keeps climbing. If you project conservatively, the solar industry alone could account for 20-25% of total annual silver demand within the next decade. Add electronics and medical uses, and you quickly approach a situation where industrial demand alone could consume the majority of annual production. That leaves little room for investment demand without creating upward price pressure. This isn't speculation, it's arithmetic. Now, let's stress test that. Assume industrial demand grows at just 2% annually, a conservative figure given current trends. Assume mining supply stays flat, which is optimistic because depletion suggests it could decline. By year 5, the gap between industrial consumption and available new supply starts to widen. By year 10, unless something dramatic changes, the gap is undeniable. That means that any surge in investment demand will collide with an already constrained market. And when constrained supply meets rising demand, prices move sharply. This is where most analyses stop. They show the imbalance and say, therefore, silver goes up. But radical transparency means going further. What are the risks? What are the potential errors in these assumptions? Let's lay them out. One risk is technological substitution. What if industries find a cheaper alternative to silver? That's possible, and history shows it has happened in some applications. But in critical areas like solar cells, silver's conductivity and efficiency are very hard to replace. Even if substitution chips away at some demand, the broader trend still leans higher. Another risk is recycling. Silver is recyclable, and as prices rise, more recycling becomes economical. That could bring additional supply, but recycling is not infinite. Much of the silver used in electronics, for example, is in such small quantities per device that recovery is inefficient. Even aggressive recycling projections don't fully offset the supply gap. Now, let's consider monetary policy. Central banks are at the center of this entire picture. When they expand balance sheets, when they keep interest rates below inflation, when they erode the purchasing power of currencies, hard assets benefit. If inflation runs hotter than expected, silver demand as a monetary hedge could surge. If deflationary pressures dominate, silver could stagnate. But history shows that over the long cycle, currencies lose value. The dollar, the euro, the yen, all have trended downward in purchasing power over decades. Hard assets preserve value. That's not opinion, that's a 100-year chart. So when you add up these numbers, supply constraints, industrial growth, historical cycles, monetary dynamics, you reach a conclusion that is hard to dismiss. Silver is mispriced. The math shows that even under conservative assumptions, the structural imbalance points to higher prices over the long term. Not tomorrow, not next week, but over the next decade. The probabilities weigh heavily in favor of upward revaluation, and that's where radical transparency of numbers sets you free from noise, because you're not basing your outlook on a headline or a guru's opinion. You're basing it on the raw inputs of reality. Now, let me be clear, math doesn't predict the exact timing. It doesn't tell you when the next spike will occur. It tells you the structural forces, the probabilities, and the range of outcomes. Timing is influenced by psychology, by speculation, by sudden shocks. But when you know the math, you don't get swayed by those fluctuations. You recognize them as part of the path, not the destination. You stay grounded in the probabilities. This is why I share the numbers openly, because once you see them, you can't unsee them. You can debate interpretations, you can challenge assumptions, but the raw arithmetic is there. And if you ignore it, you're effectively choosing to fly blind. That's why radical transparency is not just about honesty, it's about survival. It's about making decisions that align with reality rather than illusion. The unbelievable part, the part that shocks most people, is just how stark the math is once you lay it out plainly. They expect ambiguity, they expect a muddled picture. But when you see the numbers lined up, it's clear the world is heading toward structural shortage in silver, and the market has not fully priced it in. That's not a hype statement. It's not an emotional appeal. It's the direct implication of arithmetic, and here's the deeper lesson. This isn't just about silver. It's about how you think. Do you look at the world through the lens of narratives or through the lens of numbers? Narratives can feel comforting. They give you certainty in uncertain times, but numbers, when examined transparently, give you clarity, and clarity is what allows you to act intelligently even in uncertain environments. So when I say what I found is unbelievable, I don't mean it in a sensational way. I mean it in the sense that people don't believe it because they've never taken the time to run the math. They accept the noise instead of the signal. They accept the surface instead of the structure, but the structure is what determines outcomes, and once you commit yourself to radical transparency of numbers, you start to see patterns everywhere, not just in silver, but in currencies, in economies, in societies. The math reveals the truths we'd rather not face, and if you embrace that, you not only see where things are heading, you prepare yourself for it. When you look at markets, whether it's silver, gold, stocks, or currencies, the biggest mistake most people make is confusing short-term noise with long-term reality. They see a headline, they react. They see a price swing, they panic, or they chase. Their decisions are built on what happened yesterday or what might happen tomorrow, not on the deeper forces that have been building over years or decades. And this is why most investors lose, because they're focused on the daily weather instead of the climate. If you want to understand silver or any asset in a way that gives you clarity and resilience, you need to build long-term frameworks. Otherwise, you'll constantly get pulled off course by short-term noise. Let's start by being clear about what short-term noise looks like. A central banker makes a comment, a big hedge fund dumps futures contracts, a speculative frenzy hits the market, prices move up or down 5%, 10%, maybe even 20% in a matter of days or weeks. People see those moves and they project them into the future. They say silver is breaking out, it's going to the moon, or they say silver is collapsing, it's dead money. Both of these statements are driven by emotion. They're not anchored in structure, and when you look at the numbers over decades, these swings are barely a blip in the larger cycle. Take silver in 2011. The price surged to nearly $50 an ounce in a speculative frenzy, only to collapse back under $20 within a few years. If you were focused only on the short term, you either got euphoric and thought the rally would never end, or you got crushed in the downturn and walked away disillusioned. But if you look at the long-term framework, you see something different. That spike and collapse were noise within a broader structural story of supply constraints, industrial growth, and monetary dynamics. The short term didn't change the long-term trajectory. It just tested people's patience and emotional discipline. That's why long-term frameworks are critical. They act like a compass when the waves of short-term noise are tossing you around, and a good framework has three parts: understanding cycles, understanding cause and effect relationships, and understanding probability. Cycles are everywhere. Economies move in cycles. Credit moves in cycles. Commodities move in cycles. Silver has always been cyclical. You have long periods of underperformance where sentiment dies and people lose interest. Then when the imbalance builds to a breaking point, you get explosive moves upward. The mistake people make is expecting linearity. They want steady gains year after year. That's not how real-world markets work. They expand, they contract, they overshoot, they correct. If you don't have a framework that acknowledges cycles, you'll always be surprised when the market behaves cyclically. Next is cause and effect. Markets don't move randomly. There are drivers. For silver, the drivers are industrial demand, supply constraints, monetary policy, currency debasement, investor psychology, and geopolitical stress. Each of these factors has a cause and effect relationship with silver. When central banks suppress real interest rates, it makes silver more attractive as a store of value. When industrial demand rises because of renewable energy, it increases structural consumption. When mining supply stagnates, it tightens the market. Each cause has an effect, and over the long run, these effects compound. If you're only watching the short-term moves, you miss the chain of cause and effect relationships that determine the long-term outcome. Finally, probabilities. No one can predict the future with certainty. Anyone who tells you they know exactly where silver will be in 6 months or a year is lying, whether to you or to themselves. But what you can do is assign probabilities to scenarios. You can say, given the date, there's a 70% probability that silver will trend upward over the next decade because of structural imbalances. There's a 20% probability that substitution or recycling reduces demand enough to cap the upside. There's a 10% probability that unforeseen technological change renders silver less critical. You don't need 100% certainty. You just need to know the odds and tilt your decisions toward the high probability outcomes. That's what a long-term framework looks like. It recognizes cycles, it maps cause and effect, and it assigns probabilities. When you have that, the short-term noise loses its power over you. A 10% dip doesn't scare you out of your position. A speculative spike doesn't seduce you into chasing. You stay anchored. You understand where you are in the cycle. You understand what's driving the moves. You understand the probabilities of the long-term outcome. That's what separates disciplined decision-making from emotional reaction. Now, let's ground this in silver. In the short term, silver can be jerked around by futures positioning, by the dollar index, by speculative sentiment. Prices might fall even when the fundamentals are strong, or rise even when the fundamentals are weak. But zoom out and the long-term framework becomes undeniable. The supply picture is constrained. New discoveries are fewer. Mines take years to develop. Industrial demand from green energy and technology is climbing steadily. Central banks, by necessity, continue to debase currencies to manage debt burdens over a 10 to 20-year horizon. These forces point in one direction. That's not noise, that's structure. Think about debt cycles. Historically, when governments accumulate too much debt, they have three options: default, cut spending dramatically, or inflate it away. The most politically palatable option is inflation. That means printing money, holding interest rates low, letting the currency gradually lose value. When that happens, tangible assets, things that can't be printed, hold their value. Silver is one of those assets, so the long-term framework tells you as long as governments are trapped in debt cycles, silver will remain an attractive hedge. That doesn't mean the price goes up every week. It means that over the course of the cycle, silver rises higher to reflect the erosion of paper currencies. This perspective is what gives you resilience. Without it, you'd get shaken out every time silver dipped, or you'd pile in euphorically every time it spiked. With it, you hold steady, you accumulate patiently, you understand that volatility is the price of admission for long-term rewards, and you recognize that most of the noise is just that noise. It's also worth pointing out that long-term frameworks are not static. You don't set them once and forget them. You update them as new information comes in. Radical transparency with the numbers feeds into this. If industrial demand projections rise faster than expected, you adjust your probabilities upward. If technological substitution makes meaningful inroads, you adjust them downward. The framework evolves, but it remains anchored in structure, not in headlines. There's also a psychological dimension. Human beings are wired to overreact to short-term events. It's evolutionary. In the wild, if you didn't react quickly to immediate threats, you didn't survive. That wiring still drives us in markets. But in markets, reacting to every short-term movement often destroys wealth. Building long-term frameworks is a way to counteract that wiring. It forces you to slow down, to look at the bigger picture, to remind yourself of the structural forces at play. It's not natural, it takes discipline, but it's the only way to align your behavior with reality. Here's a simple example. If you look at a 1-year chart of silver, it looks noisy, unpredictable, chaotic. But if you look at a 50-year chart, the pattern is obvious. You see long stretches of dormancy followed by violent upward revaluations. You see silver respond to inflationary periods, to currency debasement, to shifts in global demand. The longer the time frame you use, the clearer the structure becomes. That's why the framework has to be long-term, because truth reveals itself more clearly in decades than in days. And when you adopt this mindset, you also stop asking the wrong questions. Instead of asking where will silver be next month, you start asking where will silver be in the next decade given the structural forces at play. Instead of asking should I buy after this dip, you ask how much exposure should I accumulate over time to align with the long-term probabilities. These questions lead to better answers because they're anchored in the right horizon. The unbelievable part is that most people don't think this way. They can't help themselves. They want instant results. They want certainty. They want to believe the latest headline, and because of that they remain trapped in the noise. They buy high, they sell low, they chase stories. Meanwhile, the few who build frameworks quietly accumulate, quietly stay the course, and quietly reap the rewards when the cycle turns in their favor. That's the lesson. Long-term frameworks are not just a strategy. They're a mindset, they're a discipline, they're the only way to see past the chaos into the clarity of structure. And once you build that skill, it applies to everything, not just silver, not just investing, but life decisions, career decisions, even relationships. Because in every domain, short-term noise tries to pull you off course. Only a long-term framework keeps you aligned with reality. So when I say don't confuse noise with structure, it's not just advice. It's a principle. It's the difference between being tossed around by every wave or steering a steady course toward your destination. And in a world that's only getting noisier, having that compass isn't optional. It's essential. When you try to understand markets, economies, or the future more broadly, you're faced with a reality that's uncomfortable for most people. Uncertainty is inescapable. You can build the most sophisticated models, study centuries of history, analyze every data point, and you will still run into the wall of unpredictability. Events happen that no one forecasted, shocks occur that break models. Assumptions fail, and if you can't acknowledge that, you set yourself up for ruin. That's why humility and uncertainty is essential. It's not a weakness, it's a strength. It's the recognition that the world is vastly more complex than your brain, your models, or your ego can fully capture. It's a safeguard against overconfidence, which is the downfall of most investors, leaders, and decision makers. If you believe you know with certainty, you'll place bets too big, you'll dismiss risks too quickly, and you'll get blindsided when reality doesn't conform to your narrative. But humility on its own is not enough. If all you have is humility, you'll be paralyzed. You'll say, I can't know anything, therefore I won't act. That's equally destructive. The balance comes in pairing humility about what you don't and can't know with conviction about what you do know and can see clearly. That combination, humility and uncertainty, conviction and clarity, is what allows you to move intelligently in an uncertain world. Let's bring this back to silver. When I ran the math, I saw structural imbalances that were undeniable supply constraints, growing industrial demand, currency debasement. Those were clear. I could have conviction there. But I also knew there were uncertainties, technological substitution, unexpected recycling breakthroughs, global recessions that reduce industrial use. I can't forecast those perfectly. I need humility there. The key is not to pretend those uncertainties don't exist, but to integrate them into my probabilities, into my position sizing, into my decision making. Here's the principle. Build your conviction on the structural forces you can see with clarity. But never bet so big that the unknowns can wipe you out. That's how you survive. That's how you thrive. Humility starts with recognizing the limits of your knowledge. No one, not you, not me, not the most decorated experts, knows exactly where silver will be a year from now. If someone says they do, they're fooling themselves or trying to fool you. Prices are influenced by thousands of variables interacting in ways that no single human can track. A geopolitical event tomorrow could swing the market. A sudden central bank intervention could distort the curve. You can't know those in advance. That's uncertainty. But conviction starts with recognizing the truths that history, data, and logic make undeniable. Over the long arc, currencies lose purchasing power. Over the long arc, tangible assets hold their value better than paper. Over the long arc, supply constraints and rising industrial demand create price pressure. Those are not opinions, they're observable truths, and when you see them clearly, you act with conviction. You don't second-guess every dip. You don't abandon your position when noise dominates. You stay aligned with the clarity you've built. Think about it like sailing. The sea is uncertain. You don't know when a storm will come or when the wind will shift. That's the humility part. but you also know your destination, you know the compass direction, and you know how your sails respond to the wind. That's the clarity part. If you're humble without conviction, you never leave port. If you're convinced without humility, you charge ahead blindly and capsize in the first storm. But if you hold both, you navigate intelligently. Now, let's look deeper at why most people fail to hold this balance. The first failure is arrogance, thinking they know more than they do. This shows up in traders who believe their model is perfect, that this time they've cracked the code. They bet heavily, they leverage up, they dismiss risks, and then an unexpected event crushes them. The second failure is fear, being so overwhelmed by uncertainty that they do nothing. They miss opportunities, they stay on the sidelines, they let inflation erode their wealth. Both failures come from not balancing humility and conviction. The solution is to build a process. Every time I make an assessment, I ask, what do I know? With clarity, what don't I know? What are the probabilities attached to each outcome? How much can I risk without being destroyed if I'm wrong? That process protects me from arrogance and from paralysis. It forces me to respect uncertainty while still acting on clarity. For silver, the clarity is this. The supply-demand imbalance is structural, not temporary. Currency debasement is ongoing, not ending. Industrial demand from renewables is rising, not shrinking. Those truths give me conviction. The uncertainty is in timing, in volatility, in short-term drivers. That humility keeps me from overcommitting, from expecting a straight line upward. The balance is what allows me to accumulate patiently, to endure volatility, to survive the unknowns while still capturing the long-term trend. Humility also forces you to stress test your ideas. If you're overconfident, you never ask, what if I'm wrong? Humility forces that question, and it's one of the most powerful questions you can ask. What if silver doesn't rise as expected? What if technology reduces its importance? What if policy shifts change the game? When you run through those scenarios, you don't abandon your conviction, you refine it. You size your bets intelligently, you diversify your exposures, you build resilience. That's humility at work. Conviction, on the other hand, forces you to act. Without conviction, you just sit there forever analyzing risks, never committing. Conviction says the evidence is strong enough, the probabilities are in my favor, the long term is clear enough, act, move, build a position, stay the course. Conviction prevents paralysis. The two forces together create a kind of equilibrium. Too much humility without conviction equals inaction. Too much conviction without humility equals overconfidence. Balance equals intelligent decision-making. Let's look at history for proof. In the 1970s, inflation surged, currencies weakened, and silver spiked. Those who had conviction in the clarity of structural imbalances profited enormously, but those who lacked humility, who assumed the spike would never end, got wiped out in the crash that followed. In the 2000s, silver again rose sharply as global liquidity expanded. The humble investor understood that volatility would come, but the conviction kept them from abandoning their position when prices corrected, and over the long term they captured the trend. This principle applies beyond silver. It applies to investing in general, to running a business, even to living a life. The world is uncertain, surprises happen, you can't know everything. That demands humility, but life also presents patterns, probabilities, structures you can see clearly. That demands conviction. Without both, you're either reckless or stagnant. With both, you're adaptive and effective. One of the most dangerous traps is mistaking clarity for certainty. Clarity means you see the big picture, the probabilities, the long-term forces. Certainty means you believe nothing can go wrong. That's a subtle but critical difference. Clarity still respects risk. Certainty ignores it, and in markets, ignoring risk is fatal. That's why I emphasize conviction and clarity, not conviction and certainty. I'm not certain silver will rise on a perfect timeline. I'm not certain it will never face setbacks, but I am clear on the structural forces that make rising prices the high probability outcome over time. That's where my conviction lies, and humility doesn't mean weakness. It doesn't mean second-guessing yourself endlessly. It means constantly updating your views as new information comes in. It means being willing to say, I was wrong, and adjusting. It means recognizing that reality doesn't care about your opinions, so you must bend to reality rather than trying to bend reality to you. That's not weakness, that's strength. So when I think about the future of silver or any asset, I hold both forces in mind. I'm humble about the fact that shocks, volatility, and surprises will occur. I don't know the exact path, but I'm convicted about the long-term clarity of the imbalance. That's why I'm confident enough to position, patient enough to endure, and flexible enough to adapt.